Hey everyone, me Kevin here. In this video, I'm going to talk about 7 stocks that I have over $700,000 invested in. I'm going to break down exactly what these stocks are, and we'll do an overview of each one. Let's get right into them after I mention that if you want my insights to help you build wealth for the long term, consider joining me on the private live streams that I hold every day the market is open, and of course the courses below on building your wealth. Use the holiday coupon code down below, it expires in 4 days, and email me if you want a bundle coupon code. Real estate, YouTube, stocks, and the psychology of money, all linked down below. All right, first up, Canoo stock. Now, this one trades under ticker symbol GOEV. Anyway, this is a company that made it onto Jay Leno's garage and merged today with Hennessy. That used to be ticker symbol HCAC, and now it's GOEV. The company promises to basically let people rent out their customizable box-style cars that sit on a skateboard interchangeable style frame which will hold your battery. So, in other words, think of it as kind of like a car, and then you could really customize what kind of box you want to put on top. Oh, you want an Amazon delivery van? No problem, we got that for you. You want something with a bench in the back for a family? No problem, we got that for you. And the interesting thing about this company is something that actually initially made me somewhat skeptical. They're going to rent out their cars on a month-to-month basis with no contract, just like you could rent out an apartment month to month. Kind of, when I first heard this, it bothered me a lot. I thought about, wait, like, why would people rent a car? That doesn't make sense. Like, you could go to Hertz and rent a car. You could Uber and not even have to have a car. You could honestly robo-taxi probably in a few years when these things start hitting the road. And then I got to thinking, no, maybe the month-to-month model could actually be genius, especially when you pair it with an oversimplified design. See, you're now getting people into their own autonomous vehicles that could probably be introduced into a robo-taxi network as well, that people can rent on a month-to-month basis so they could really try it before they buy it in essence, and they never actually have to buy it, which is kind of cool. They're electric vehicles, which means people are getting into the vehicles without being concerned that the battery's going to fail or some sort of maintenance issue because, well, after all, they're just leasing it on a month-to-month basis, essentially. They could cancel at any point, and then there's no commitment. I don't even think there's a down payment, and I'm not certain about that. I guess we'll see when the pricing comes out. But really, it's kind of like really almost renting a car versus even having a lease contract or a purchase contract. I personally like owning things, but in today's culture and society, especially since this is going to start out in LA, I kind of think this could be an interesting play that might target more of that millennial, minimalistic culture. And don't get me wrong, I was still skeptical because I know the management is like, oh yeah, we're going to target millennials. And I'm like, well, I mean, I'm a millennial and I still kind of want my own car, you know? I mean, I get it. If I rent it month to month, it is my car, but is it really? Anyway, I was skeptical, did a little bit of research, and apparently car subscription services like this have been tried before. And on average, people tend to rent these things for 16 to 17 months, not specifically at this company, but in general with car subscription services. So to me, I thought, that's actually not bad. You know, that gives people a lot of flexibility. It gets people over sort of the EV fear. Like, hey, just try it out. You don't like it after 30 days? Forget about it. Just rent it for 30 days then, you know? Maybe you get in at a cheaper price than if you were renting it day to day or probably Ubering. And it'd probably be, I would imagine, a little bit more expensive than if you bought it or leased it. But then again, they'd have to be competitive as well. So we'll see how that works. And also, since they're EVs, they've got less parts that actually have to be maintained, which could help lead to more profitability for the company in the future. So this company really started piquing my interest, especially since you've got that selling pitch to customers of freedom. People love freedom. I know that because when I try to tell people to buy a house, they're like, I don't want to be tied down by a 30-year mortgage. And I'm like, it's the best investment you can make is real estate. But hey, whatever. Topic for a different video, I suppose. You can watch the videos on my channel. Just type in Meet Kevin, Retire Early. Watch those videos. Anyway, I mean, think about it. You're really now giving people cars without them inheriting depreciation or the hassle of selling or trade-ins, which might not be so good for shift stock, but, you know, we'll talk about that one later. But anyway, worst case scenario, if the company's subscription model doesn't work out, they could always just switch to selling the cars. The company is partnering with NVIDIA for their self-driving technology, and I currently invested $70,500 into this company. So, hey, fingers crossed. It's a SPAC, so we've really only got pro forma financials. We're not going to do a deep dive on pro forma financials in this video. So instead, let's go on over to, that's my transition for saying next company. And the next company is XL Fleet, which makes you think it's extra large. I don't know what it stands for, but XL Fleet. Anyway, so today, this company merged with the SPAC PIC, and so now this company trades under ticker symbol XL. And XL Fleet, to me, is kind of like the Hyliion, except where Hyliion tries to make semi-trucks hybrids, which I've already done a deep dive on Hyliion. You could see that video. Just type into YouTube, meet Kevin Hyliion. XL Fleet is more of like the hybrid company trying to do the same thing, except not to semi-trucks, but to ambulances, Ford Transits, Ford trucks, and kind of think like medium duty instead of semi-trucks, like U-Hauls. Right? Anyway, basically, this company takes regular gas trucks and retrofits them with a hybrid system, and they suggest that they save you mileage, so you get a return on your investment by doing this as a company. Now, medium, mid-sized cars and trucks, you know, they don't do the same thing that semi-trucks do. Semi-trucks, they're on the road usually more hours than mid-sized cars are, and you get more miles on them. So sometimes those hybrid and efficiency plays can be better suited for, well, distance hauling, like semi-trucks. But anyway, okay, so the company's got some sales. And, you know, when I did a little bit more deep diving, I started unveiling a few issues. So the company boasts on its, you know, website and its blog and its social media that it's sold products to big names like Coca-Cola, DHL, Safelite, FedEx, even the Seattle Fire Department. And, you know, when I hear about that, I'm like, oh, wow, that's great. And the way they sort of present it to you implies that these are all recent customers. But unfortunately, what they don't tell you is the following. I wrote this down. FedEx's last order with them was apparently in 2013 when they bought 10 systems from XL Fleet. And then 5 years later, instead of buying from XL Fleet again, FedEx bought electric trucks from a different company called FDG. DHL was a customer, and then they bought electric trucks from Workhorse. ThyssenKrupp, the elevator company, bought some systems from XL Fleet in 2014. Seattle Fire bought 10 systems in 2016. Coca-Cola bought 10 systems between 2010 and 2013. But all of these companies, at least as far as I can tell, haven't been buying from XL Fleet since then. So from what I could tell, and I could be wrong here, but when you got companies like FedEx and DHL definitely buying XL Fleet products and then buying other people's stuff thereafter, it's a little bit of a diss to XL Fleet, okay? Like, if I were XL Fleet, I'd be like, oh, how could you? But it might also be a signal that maybe your product just wasn't. Anyway, that made me a little nervous. So I did a little bit more research, and I know that Jim Cramer pumped them up, and I bought a little bit of shares of the company initially, and then I did some more research. I put in about $17,000 into the company, which is a lot of money, don't get me wrong, but relative to some of my other investments in this video, it's the smallest investment. And after doing my further due diligence, which I should have completed beforehand, but you know, sometimes you do your initial research, and then you put in a little bit of money, and then you do more research and you could always sell, right? That's what happened in this scenario, okay? So we're not gonna complain about the timing, made a few $1,000, sold out of this position. I rarely sell. But XL Fleet, if you see that ticker symbol XL, it's just my take on it, okay? But it got worse. See, I did a little calculation. If a pickup truck is retrofitted with an XL Fleet hybrid system, and let's say that pickup truck gets 25 miles to the gallon and they drive 200 miles per day, the pickup truck would then be spending about $24 of money on gas per day. It's about $3 per gallon and 25 miles to the gallon. And at 220 working days per year, you know, with vacation and sick time for workers and stuff, usually you're working around 220 to 240 days per year. That works out to about $5,280 in gas, assuming it drives 200 miles a day. Well, when XL Fleets did a study of their partnership with Coke, XL Fleet boasted that they saved about 20% on fuel economy for Coke. Okay, so 20%, using their number, their 20%. 20% times $5,280 in gas for a pickup for a year works out to saving about $1,056 a year. Okay, I mean, that's good. Like, you're making money, right? But wait a minute. The system costs you $9,000, so it would take you over 8 years just to pay back the system, and the average length of ownership for a car is usually 6 to 7 years. A commercial car, who knows, could potentially be shorter. A pickup truck, we'll see. Depends, I guess, how much is driven. But anyway, to me, that was a little bit of the nail in the coffin. So let's just say XL Fleet, hey, thanks for the few grand. I've moved on. All right, next stock. This is a high-flying one. Peloton. Yesterday, Peloton stated that they would acquire Precore, which is a gym equipment manufacturer. Peloton's website data, by the way, has been skyrocketing, even when compared to Nordic Track, who is actively trying to compete with Peloton. Peloton's website data over the last 6 months is up 43% compared to Nordic Track, which is only up about 16%. The bounce rate at Nordic Track is 48%, which means basically 50% of people are bouncing out of their website. At the same time, Peloton's bounce rate is only 30%, which is a little less than 1/3. Also, people spend about 1 minute longer on Peloton's website than they do on Nordic Track's website, which might help explain why Peloton has a really long wait time to get the Peloton bikes or treadmills. These are backordered months, to the point where I even heard some people had December delivery dates that got canceled and delayed till February. But now, look, Peloton picked up Precore, so what does that mean? Well, Precore acquisition could actually be priceless. See, they've got a massive facility to manufacture high-quality gym equipment. In fact, if you just Google Precore gym equipment, you'll see that it's not the cheesy kind of gym equipment. It's that higher quality equipment that you'd see at maybe the nicer hotels, or like when you go into the gym at a hotel and it's like, oh, they got all the nice new stuff. Yeah, Precore does a lot of that stuff. Really nice. Aligns with Peloton's brand. If anything, Peloton got a deal. They bought these for just about $420 million, and quite frankly, the company's got more value. Precore has more value than $420 million in it, so I feel like Peloton got a sick deal here because Precore's having trouble selling product to hotels, and Peloton instead is like, let's go bottom feeding. Peloton's got like $2 billion in cash, so okay, what? 20% of their cash got burned on getting massive factory capabilities, and not only that, but now they also have the ability, in theory, to expand into, get this, Peloton weight machines, Peloton ellipticals, Peloton, stair climbers. Precore does all that stuff. Peloton doesn't have to reinvent the wheel. They could literally buy a company that makes the wheel, slap the brand on it, and boom, Peloton subscription service me up. Anyway, in terms of Peloton and their staying power, the interesting thing about Peloton is Peloton wins from something very fascinating known as the stickiness of gym membership. And they also win from this pandemic, but not just because it's a stay-at-home play, and I'm going to explain the stickiness of gym membership thing in a moment. But see, the cool thing about Peloton is Peloton used to sell, and they still do in malls that have reopened, but they used to sell almost exclusively in person in malls with commissioned salespeople that would take like 25% cuts on the profits on these machines. Because of the pandemic, Peloton has gone so almost sustainably viral that when people think of gym equipment, they think of Peloton. And now all of a sudden, people are buying this equipment through the website without Peloton having to pay out a commission, which sucks for the salespeople, but it leads to significantly more profit at Peloton. This is actually one of the reasons I started buying Peloton at $29 a share. And I've been mentioning it on this channel. I've mentioned it in my course. Peloton's always been in my 1333. It's been in my top list of stocks as well since March. You can actually go to metkevin.com/top, and you'll probably still see my older top pie. Redfin, Etsy, Tesla's in there. You could look at those. Great stocks, some of my largest holdings. But see, not only does Peloton benefit from this, but they also benefit from something known as the stickiness of gym memberships. And this is really evil too. Like, they've got a couple really evil things going on here, beyond just being a stay-at-home play. Peloton's stickiness of gym membership aspect is, well, let's put it this way. More than half of all Americans have or with a gym membership don't go to the gym. So you got about 50 million Americans who have a gym membership. Some estimates say 60 million Americans. And only half of them are actually going to the gym. You get more than half of the people not going to the gym. And why do you think that is? Like, seriously, think to yourself, why would somebody have a gym membership and not go? Like, why don't you just cancel the subscription? Well, here's the psychological trap. And if you go to the gym all the time, this isn't going to make sense. This is going to sound like blasphemy, okay? But you got to think about the people who don't go to the gym all the time. Like the people who come in January for a couple weeks and then they don't come the rest of the year, okay? The fact is, when you have a subscription to a gym and you don't go, You feel guilty about not going to the gym. You know you've got the gym subscription. You know you've got the Peloton subscription, but you keep telling yourself that you're gonna go, that soon you'll be back. So you keep paying the subscription because guess what happens if you cancel the subscription? You subconsciously failed. Some people just blatantly feel like they failed. It's like canceling yourself, canceling your health. And this is why Peloton has a relatively low churn rate. They've got a churn rate on a monthly basis of about 0.9%. Their average over the last 12 months has been a retention rate of 94%. And even if their churn rate was 10 to 15%, this company is growing subscribers at an insane base. They have literally doubled their revenues in 18, 19, and 20, and probably will do it again in 2021. Their growth will slow by 2022, probably down to like 30% instead of doubling, which, yeah, they're going to slow down after the pandemic, but we'll see if they continue to introduce new product lines with this Precore acquisition. This could be a 3x stock. And don't get me wrong, the other companies I'm investing in as well, Canoo, could be a 3x stock. XL, could 3x, but I don't want to be a part of it. Canoo, Peloton, much more interested. These are companies that, along with the other ones I'm about to mention, these are real potential 3x stocks here. Even at where Peloton is now, this acquisition, game changer for Peloton, especially considering the other facts. So we're not doing a deep dive, obviously, on these in this video, but let's get to the next 3xer. It's going to be Tattooed Chef. Tattooed Chef. Oh, Tattooed Chef. Oh, Tattooed Chef. This is a company that I pitched to course members, and then a couple days later, we did a video on the channel on it. This is just my holding in Webull here. This is about half of my holding in Tattooed Chef. So you can see I bought it for $18.75 and $18.63. It's at $25.24 right now, so up about 35%. So it's been a pretty good trade so far. I plan to hold this one. Not going to sell out. Rarely do I sell stocks when I buy them. And I generally always make a video on, even on the public channel when I sell stocks, because it's so freaking rare that I sell a stock. I just like buying and holding. It's bad. Anyway, here's a $19 stock. Well, it was a $19 stock. Here's now a $25 stock that, in my opinion, could easily go to $60. That is triple from when I first recommended it. The best thing that I could recommend to you, and I'm not sponsored here, the only thing that's really sponsored in my videos is you actually using that platform like Webull to get yourself 4 free stocks when you deposit $100, or getting life insurance in the link down below, which you can get in as little as 5 minutes without talking to anyone. Anyway, those things are sponsored. Tattoo Chef, not sponsored. It'd be kind of cool if they want to sponsor me, I'll take it. But order some of their food. Okay, just an idea. Like, I personally hate the idea of plant-based pepperoni, salami, or cauliflower burgers. But let's just say when I tried some of their food, I was pleasantly blown away. Like, usually I gag at the thought of, like, is this plant-based? And then I'm like my throat's just sealing up. Maybe I just really enjoy meat. Sorry if you don't like meat. But I know that plant-based meat is way healthier, so let's just say Tattooed Chef might make me a believer. So far, I'm very excited. This stock, by the way, has about a 19% short position against it, which that's a good chunk. You know, Lemonade had a short squeeze not too long ago. Lemonade's a stock that I've been pitching for 3 months on this channel and to course members, and that went from 48 to now it's $114. Oh my gosh. I got some, we can go over to Robinhood here. We got some Lemonade calls here. These are my total returns on Lemonade calls. Here's one that's 53K, 43K on Lemonade. There's another 43.7K. Geez, the Lemonade calls. The only loser on this picture here is Domino's. The hell, Domino's? Anywho, yeah, so Tattooed Chef, love it. Lemonade, a little pricey right now. You know, I'm not going to sell any Lemonade. I got some longer term calls here, 2023 calls on Lemonade. We'll just let those ride for now. But on Tattooed Chef, I did invest around $180,000 to $200,000, depending on how, you know, gotta add this all up. But anyway, I showed you the Webull. The other ones are, the other shares of Tattooed Chef that I have are in M1 Finance and JP Morgan, and they've got about a similar cost basis. So that's my position in Tattooed. I don't know that I'm going to keep expanding that position. I think I can kind of let this one run. If it dips, though, if I see Tattooed Chef go down to like 23, I'll probably add another 50 or something like that. We'll see. All right, next up is Shift. Shift is a used car company focused on e-commerce. I did a deep dive on this one, so also not going to go crazy deep here, but let's give you a little overview here. This is a company that delivered 2,946 used car e-commerce sales, which the e-commerce business is expected to 10x over this next decade here, probably even sooner. They delivered sales along expectations. Their revenue was higher than expectations. Everything was good until their advertising expenses. In the last quarter, they really shocked Wall Street with unusually high advertising expenses. The management says this was because of COVID, but it led the stock to sell off. I bought after the sell-off. I thought, okay, yeah, like this could be a good entry point, and like the high sevens is where I bought in. Mid to high sevens, I bought in over a few days. Anyway, management thinks their advertising will actually catapult them forward substantially, and the best way to look at this is just think about like a Vroom or Carvana. These are Shift's competitors. They advertise like crazy, and they're growing market share because of that. And Shift really operates in like 1/6 as many markets as Carvana, and it's sort of the baby of the group. But it's also the cheapest on a valuation basis and a multiple basis. It's very inexpensive. Bloomberg even says they have like a 0.02% chance of default, like next to nothing. So to me, this is a 4x stock once, and not like 4x, like international currencies, no, like 4x, like a 4-banger. As of November 13th, for example, BTIG, an investment group, says they've been tracking Shift's inventory movement, and things are moving along at a, quote, strong clip. Anyway, the problem with this company is they've got some downward pressure from lockups after their SPAC merger, so we've got some short-term risk at this company, as original investors might just flock to the next big thing, like the next Canoo or QuantumScape or whatever. I think that'll end up being a regret, especially since we're going to see this e-commerce used car sales business explode, probably even over the next 5 years, it'll 10x. And to me, there's no reason why in the used car space somebody would not want to price shop Carvana, especially when Carvana openly says that they're profiting over $4,500 per car on average. Probably shouldn't go on Jim Cramer's Mad Money show and brag about that. Makes people want to price shop. Anyway, briefly want to touch on QuantumScape and Microvision. These are the next two we're going to touch on. Ooh, fixer. Bring contractors. You got to get those Redfin notifications, folks. Ooh, might have a real estate deal here. Anyway, QuantumScape. Oh, which, by the way, if you want to find real estate deals before they hit the market, go to metkevin.com/deals. It's a great way to basically put yourself in front of sellers for a very inexpensive price by purposefully targeting homes that look distressed and trying to get those properties before they hit the market. Anyway, QuantumScape is a recent SPAC merger with the former Tesla co-founder. He's running this company. It's a battery tech company, and they promise to have found a breakthrough in solid-state battery technology with batteries that can be charged up to 80% within 15 minutes, which is insane, and basically last over 250,000 miles of drive capability without battery degradation. That means these batteries could easily last over 2 million miles before actually bricking. However, the problem is this company only has a lab sample of their product thus far. They don't actually have a real product. That does make me nervous. I have a little bit of money at play with this company. I shouldn't say a little bit of money. I'm sorry. Relative to my portfolio, this is it's a small slice, but it's a good chunk of change. I have $30,000 invested in this company. It's relative to the portfolio. It's very small because it's speculative. Always look at percentage base. Anyway. QuantumScape is one that continues to run. It kind of makes me feel like it's going to bubble crash sometime soon, which honestly I wouldn't mind because I kind of would like to buy this thing a little cheaper. Anywho, the next one, but Quantum is one that could 3x if their battery technology continues to prove itself. We'll see. Then we have Microvision. Microvision is a LiDAR play. It is the cheapest out of the Velodyne and Luminaire LiDAR stocks. With Apple's recent announcement of electric vehicle ambitions coming in 2024, Microvision shot up and mostly stayed up despite a short seller coming out to rag on them. Quite frankly, the fact is, Microvision and QuantumScape are both speculative companies. Microvision and QuantumScape are actually no better than Nano Dimension. See, the problem is Microvision and QuantumScape, they don't actually have a real product yet. So All of these 3 companies here, I guess towards the end of the video, they're a little bit more on the speculative side. I do have money invested in QuantumScape and Microvision, MVIS and QS. I do not have money invested in Nano Dimension. I have a full breakdown video on Nano Dimension. Great video. You should watch that. You get all my thoughts on Nano Dimension. Just type it into YouTube. Meet Kevin Nano Dimension. A really great company. You know, obviously, looking back at the stock price now, it's like, oh, I should have invested when I made the video, and that's okay. You know, I think I gave a very fair and balanced explanation of my thoughts on the company, and I see the potential for Nano Dimension. I think it's a great company. I don't regret not investing in Nano, though, because I am very concerned that we don't actually have an end user yet for skin adhered circuitry or multi-layered printed circuit boards made with additive technology. And if none of that just made sense, watch the Nano Dimension video. But I don't see an end user for that yet. Whereas with Microvision could be bought by Apple or really any EV company for their LiDAR technology. They're dirt cheap relative to like even the valuation in Neo. I mean, you could take like 1/40th of Neo, break that off, and boom, you'd buy Microvision. Yeah, relatively cheap company here. I mean, this is like penny stock level, almost. I mean, they just graduated from penny stock. And then you've got Quantum, which also no product yet, but the uses for that battery technology, endless. In fact, honestly, for Nano Dimension to succeed with especially their like skin adhered circuitry, you need better battery technology. So it's almost like Quantum has to succeed for Nano to succeed. Not really, but I think you know what I mean. Anyway, I've got about $203,000 invested in Shift and about 30 to 50 of each of these kind of smaller ones with the exception of Nano. All in all, out of all the stocks I mentioned here, I'm in about 700K and probably could break that down a little bit cleaner, but I think you got my overview here. And yeah, hopefully you appreciated this. And if you did, consider sharing it. It's just my perspectives. And if you lose money, well, don't sue me, bro, and we'll see you in the next video. Instead, just check out the courses down below and email me for the bundle coupon code. It'll make you feel better. You'll get a discount, a good discount, which expires at the end of the day on Christmas, so yeah. Anyway, thanks for watching, folks. We'll see you in the next video.